Companies worth billions of dollars can fold due to a single catastrophic event. In the world of retail, few names evoke nostalgia like Toys R Us. At its peak, the company was worth billions of dollars and had a presence in over 30 countries. However, by 2017, the once iconic toy retailer had filed for bankruptcy, marking one of the largest retail failures in history. The demise of Toys R Us serves as a stark reminder that even the most successful companies can fall victim to a perfect storm of factors, including shifting consumer behavior, increased competition from online retailers, and a failure to adapt to changing market trends. In 2010, Amazon acquired Quidsi, the parent company of diapers, Calm and soap. Calm, for a whopping $545 million. On the surface, this deal seemed like a shrewd move by Amazon to expand its e-commerce capabilities and further establish itself as a leader in the online retail space. However, the acquisition ultimately proved to be a costly mistake. Under Amazon's leadership, Quidsi's management structure was dismantled, and the company's innovative culture was lost. The disruption to diapers, Calm's supply chain and distribution network resulted in a significant decline in customer satisfaction, ultimately leading to a substantial loss of market share. By the end of 2017, Amazon had closed both diapers, Calm and soap, Calm, ceasing operations after just a few years of ownership. This marked Amazon's first major acquisition failure, highlighting the risks of hubris and expansion. The lesson here is clear. Even the largest and most successful companies can fail when they prioritize growth over innovation and customer satisfaction. By ignoring the unique strengths and cultures of acquired companies, Amazon ultimately killed the very businesses it had sought to acquire. We're going to turn the clock back to 2008, when Blockbuster was still the largest video rental chain in the world. Despite its success, Blockbuster had a clear opportunity to shift gears and adapt to the changing market. Instead, the company stuck to its brick-and-mortar model and resisted the transition to online streaming. In fact, Blockbuster had a chance to acquire Netflix for $50 million in 2000, but it declined the offer. Just 5 years later, Netflix was valued at over $2 billion, and Blockbuster was struggling to stay afloat. The writing was on the wall, but Blockbuster continued to focus on in-store rentals and eventually filed for bankruptcy in 2010. The company's failure serves as a stark reminder of the dangers of complacency and the importance of innovation. A single miscalculation, a missed opportunity, or a delayed response to disruption can be the difference between success and bankruptcy. As the saying goes, nobody knows when their last ride will be. And Blockbuster's story is a chilling example of what happens when companies fail to adapt to the changing landscape. Gymboree, once a staple in the children's clothing market, made a series of strategic moves in an attempt to stay ahead of the competition. The company expanded its product lines to include shoes, accessories, and even toys. They also ventured into new markets by launching their own branded children's clothing lines. However, these expansion efforts came at a significant cost. The company took on substantial debt to fund these initiatives, which ultimately weighed heavily on their finances. In 2017, Gymboree filed for bankruptcy, citing over $1 billion in debt. This cautionary tale highlights the risks of overexpansion and the importance of maintaining a clear focus on core business operations. If a company is not careful, the pursuit of growth and innovation can quickly turn into a recipe for disaster. By prioritizing sound financial management and strategic decision-making, business leaders can avoid the pitfalls that led to Gymboree's downfall. In reflecting on these high-profile bankruptcies, we can identify a few crucial lessons. Firstly, even the most successful companies can become complacent and misjudge consumer preferences. Secondly, overexpansion and hubris can be just as damaging as underinvestment. Lastly, failure to adapt to changing market conditions is often a recipe for disaster. By applying these lessons, business leaders can better navigate the shifting landscape of their industries.